Well, welcome to another episode of Newcastle Unlocked. I'm your host, Brent Sinclair, and today we're looking at providing a bit of a market wrap for the 2025 financial year, covering off on the commercial, industrial and residential sectors. Look, it's been a busy couple of weeks with market activity. We've had a federal election that's come and gone, really not with a lot of impact on the market that we've seen as yet. There's a few things that have come out of it that we'll see how they go. We've also had a rate cut this last week. So that will probably have a bit more of a material impact, and we'll dive into sort of how that will play out over the next sort of period and what that looks like. But to help me unwrap everything to do with the market, I'm joined by Dan Barry, Director in Industrial, and Matt Shaw, who's joined us now in the commercial sales teams. Thanks for joining us, gents.
Thanks Brent.
So where do we start? So looking back, I think the last 12 months have been interesting. I think 2024 was a very difficult year for the market, although we're getting plenty of transactions done. It was just hard to get deals done, really. I think the fact we've had elevated interest rates, we've had elevated construction costs, and that's just, I don't think there was a lack of intent or demand. I think looking at our numbers for demand, I think inquiry levels are quite strong. I just think it was a bit challenging to, just try and get over the top with those deals. I think there's just too much of a disconnect between vendor expectation and buyer expectation. But look, we've just had a rate cut, which I think's, a major impact on sentiment in the market. And I think this all started at the back end of last year when, there was talk of there was a rate cut coming in, possibly early this year. And, it's actually materialized. And I think that's probably the difference in, even the period gone past, even in 2024, to actually see not only talk of it, but it materialized, and just that bit of confidence that it injected in February. Fast forward to May, we've had another 25 basis point cut as well. So that's 50 basis points of easing so far this calendar year. And it's really just a signal to the market that we're entering that new rate cut cycle. And it's being echoed by the banks as well. We're looking at, all the four major banks predicting rate cuts to the end of the calendar year. We've got CBA, Westpac and ANZ all predicting rate cuts down to 3.35%, currently sitting at 3.85%. And we've got NAB predicting as low as 2.85%. So I think, as the trajectory goes, and the fact that I've actually seen the rate cuts occur this year is going to inject a lot of confidence. So, personally, I think, I've noticed it as we've entered this in 2025, the first half of this year, there's definitely been a lot more positive conversations coming out of it. Interestingly, looking back at when we caught up, gents, in December, whilst, we're still getting deals done, I think the conversation was still very cautious about, how things were going to play out with the backdrop of some of these challenges that we're having. But, fast forward through to May, I think that we're looking, quite good. And the back end of this year is really where these rate cuts are going to start to show up, especially if the trajectory continues. We'll get into that a little bit more. We've had the federal election. Really, I don't think that there was a major, typically around election time, we have a pause in major transactions, both from buyers and sellers. There's just that uncertainty, not wanting to commit until there's a bit more clarity on exactly how things are going to play out in the backdrop of the economic environment. But look, this year compared to previous federal elections, I didn't see much of that. There's one policy in particular that's probably going to come up, and we'll talk more about it going forward about the super above 3 million. But I don't think really anything dramatic. There was no sort of major transactions put on hold that we were aware of, or any disruption to our activity as well. But it will be curious to see how this new super tax comes into play, and how that just changes the buying attitude and also the structuring of deals coming forward. So look, really, we want to just dive in and see how, really from Matt and Dan's perspective, just to get a sort of well-rounded opinion on where we sit and what they've seen in the last 12 months. But gents, sort of kicking off the rate cut, that's probably the biggest news that's in our market. What was your take on that? And what do you think? What do you think's going to play out for the next 6 months?
Thanks, Brent. Look, I echo sort of your comments earlier. Like, it's now happening, the rate cuts. I know sort of if we go back, 12 months or 18 months ago, where coming into 2024, there was talk and forecast from the major lenders that there would be rate cuts in 2024, and the RBA just decided to hold pretty much through the whole of the calendar year. And I think now that it's actually happening, the rubber's meeting the road, so to speak, in terms of rate cuts, it's just injecting confidence into the market.
Yeah.
There's been talk of it, and now it's actually happening. And we've had two, and there's expected at least another two or three from most of the major lenders. I think that's just going to springboard us into some better times for the commercial property market generally, but particularly here in Newcastle.
Yeah. Right, you, Dan, what do you reckon?
Yeah, I think it's going to increase the participation. So the engagement has always been there, as we know. But, if we say focused on a price bracket of 5 to 10 million investment stock, it's the same 10 to 15 people generally that have participated for the last 12, 18 months. So I think what's going to happen is, whilst the engagement and inquiry numbers have been good, it's going to further force that participation. So more bids at auction, more participation in EOI campaigns. So that number might go to 20, 30.
Yeah. And I think too, like on top of that, you've still had strong participation from, as you say, the usual sort of suspects, and that's been for the industrial market. The office market's been a bit more of a challenge, but I think with rate cuts, you're going to have, I think the participation levels there, proportionally will increase because you're coming off a lower base. So, I see positive signs for both of those sectors, and hopefully it's going to be good moving forward.
Yeah, I think that just that signal to the market, we're in that rate cut cycle. Investors having actually seen it actually occur, especially the two in succession this first half of the year, they're going to start pricing that in. They're going to have a bit more confidence that we are on that downward trajectory. It's that new cycle that's coming in. So participation leading into being able to pay that little bit more, or possibly the fees are looking a little bit more positive because you sort of have that longer lead out prediction for projects. So yeah, look, it is definitely good news for investors. I think the intent, as I mentioned earlier, I think the intent's been there throughout the financial year. It's just been, interest rates have had elevated interest rates have had such a constraint on decision making. We haven't had lack of interest. It's just getting the deals done. So I think that's going to, definitely help bridge that gap going forward. And it's a little bit early to see how this latest one, plays out. But I do think in the coming weeks and months, we're going to see that, in the back end of this year, increase that those transaction volumes. And I touched on it earlier. We've had the federal election, probably the big policy. And look, we're not, without sort of diving into some of the politics of it, but the Labor's plan for a increase on tax for super above 3 million. That's probably the big, property centric policy that we're curious to see how that plays out. Mainly from an agency perspective, how's that going to change decision making? Now, obviously, it hasn't actually passed through at this stage. But it's planned for the 1st of July. Probably more likely than not that it will happen. But we're only sort of commentators on this. But I suppose we're already starting to see our clients making decisions as if it's occurring, and it's obviously targeting sort of the high net worth or the wealthy investors. But 3 million above, looking at doubling it from 15% up to 30%, plus also a potential tax on unrealised gains above 3 million. Now we're aware there's obviously some, how the thresholds are applied if there's more than 2 people in the self-managed super fund. But we deal a lot with self-managed super funds in our day to day. And look, please get your own financial advice on how that plays out. But how is that going to change? And look, as I said, we've already had some clients looking at, shifting shifting assets out of their super fund into family trusts or other companies just to, have a better tax strategy. So, have you guys had much conversations with your clients about, what their plans are?
Yeah, so I guess I've got a couple of examples I can give. So the recent auction campaign we ran, one of the bidders came to me and said, so the auction was ran on the 1st of May, obviously 2 days before the election. He said, look, I want to make an offer with some form of rescission clause from my super fund to another company that I have, should this come in. And that was something that ultimately they weren't the buyer, but it was something that was, that was probably the first exposure I had to it, where someone was thinking like on that prospect. But the other thing that I've noticed is I've had 3 or 4 conversations with clients already about it. The mindset seems to be no one's going to pay the tax. They're going to do the transfer.
Yep.
That's, and we're talking considerable super fund values, but varying. But yeah, the mindset is they're going to pay the transfer, not the tax.
Right, you, Matt, have you had many conversations?
Not too many, but I know it's pretty unpopular. And I don't want to, form a political opinion here on the podcast, but it's just going to be interesting to see how it plays out and how demonized it gets in the media. It's already had a fair bit of negative press. So yeah, as you say, it looks like it's going to happen. And I guess, with Labor winning with a pretty large majority in the election, that it possibly will. But could it go down the path of how unpopular the mining tax was? I don't know. But yeah, it's definitely a challenge for investors out there who we deal with that have got sizable self-managed super funds.
Yeah, look, it's a tricky one, really. I think that not a lot of time for the 1st of July either. So, and I'm probably curious to see just how, it is what it is. If it comes in, the market will adjust. It'll be mainly internal transfers and shifting of structures more than probably disposals, although there's probably going to be some disposals, although there's not a lot of time to do it if that's when it happens. So, but yeah, just about the attitudes going forward and how the purchasing, I don't know how it's going to change too dramatically, but it's too early to tell. So I think we've only just had the election. The policy's coming in soon, although there's been a bit of a, it's been forecasted for a while if Labor were to win, which they did. So anyway, it'll be one to keep an eye on. That capital gain, the gain on unrealized, the tax on unrealized gains is a tricky one too. So we'll see how that plays out. But anyhow, we forge on. So looking, I suppose, with those out of the way, getting into the sectors and just seeing sort of where things have sat, a little bit of a, where we've come from for the last 12 months, where we're headed as well. I think it'd be great for the listeners to sort of understand what our views are on, going through each of the sectors. So I'll start off with Dan. So, mate, what's happening in industrial? What's the financial year been like, and where we're heading?
Yeah, so the start of the year started well, particularly on the back of that February rate cut. Inquiry levels were strong. After sort of that cooled down a little bit, it was a little subdued. I would say, regardless of what's sort of happening in relation to inquiry levels, there's still a flight. There's three things that I've taken away. There's a flight to quality. Investor demand is still strong, particularly in that $5 to $10 million bracket. And owner occupiers are leading the land market.
Yeah. And where do you see how are rents evolving? We've had a couple of discussions recently about some renewals, and have had some gains there versus the new builds. How is that evolving? Where are they headed to? I think even last time you gave a horizon of maybe 2 years to 3 years for this rent reversion to sort of equalise. But where are we at now, sort of 6 months on from that last discussion that we had?
Yeah, so there's been quite a lot of renewals now. Let's say passing rentals in the range of 130 to 140 a metre.
Yep.
They're now 180, 190. So, and that's built stock. Replacement costs have seen developers require that low 200s number, which I think, unless we get some relief with these interest rates, I think that will remain the same, just because it's return on cost. If the cost is $3,000 a metre, around a 7.25% return is about 220 a metre.
Yep. And we recently ran an auction campaign, and covering off on a few parts for industrial. So we're talking yields, we're talking rent reversion. We've now had a rate cut as well. Like, has the rate cut? And it doesn't always transition directly to, yield compression, but how do you see that effect on the market in the backdrop, even having some success at this recent auction campaign? Can you talk us through the auction and maybe, how some of these, the interest rate cut is affecting the market?
Yeah, sure. So I think going back to 2022, when we were selling property in the 5.25%, 5.5% yield range, if you look at the rate per metre improved, it was still around that $3,000 a metre.
Yep.
The property we sold at auction, 13 Babilla, it was around 6.25%, $175 passing rental per metre, and it's around $2,800 a metre. So the reversion the previous rental before that was $150 a metre before the renewal was done.
Yep.
The reversion is bailing out the rate per metre improved.
Yep.
So the numbers are similar,
Mm.
but the yield is obviously higher because the debt's higher, opposed to 3 years ago.
So the growth in market rents just offsetting cap rate softening, right?
Mm.
Whereas when the office market's been different, you had a significant softening, but just not not that growth in market rents. So I guess that's why there's still that strong interest in the industrial sector, because the underlying fundamentals of it, whether it's rent, whether it's land values, demand and supply dynamics, are still very strong, and that's certainly for our market and just for the industrial market, across the board.
And look, yields don't follow directly in line with rate cuts, but assuming borrowing costs are passed on and there's 100 basis points over the year, do you see much compression in the industrial yields? Is that the driver behind it, or do you think that it's not, maybe there's not as much in the tank as say office space?
Well, I think the last year investors have largely targeted below replacement cost purchasing.
Yeah. Okay.
So if they can buy something below replacement cost or at a premium to land value, slight premium to land value, that's what they're targeting. Now, what I think will happen is, let's work off NAB, best case scenario here, we're getting 100 basis points from today. Let's say half of that's passed on. So, for top end stock, we're chasing that 5.5% yield range, say. What I think that means, probably most importantly, is for developers. So at the moment, I imagine most developers, you'd have to be a builder developer to sort of make something work at 7%. A retail developer is probably more like 8%. What I think that means, the opportunity for them is, instead of needing that $220 a metre, they can do it for 200 or 7%, knowing they can sell it on for 5.5 if they choose to. Where at the moment, the gap is 7.25, 7.5 to 6.5.
Well, in their developer feasibility, like, they're going to have, potentially, call it 50 basis points cap rate softening on the end value, as well as cheaper debt throughout the construction. So, those couple of metrics just there make, feasibilities more feasible, but makes the that required rent, perhaps $20 a square metre cheaper.
And I think why investors are largely driving towards industrial is it's a very simple product. It doesn't have an extensive, obviously has an office component, but it's not a 100% fitted out office component that will be outdated in 10 years. It's a simple product. They're functional. They're adaptable.
There's only a few inputs into a feasibility.
Yep. And we ran our auction program last month. This month. Sold 3 out of the 4 properties. What was some of your takeaways from that? We obviously had a lean towards industrial offerings. What was the takeaway from that? Both of you had assets in there, as I did as well. But what were some of your takeaways from that program?
Yeah, so I guess the first takeaway is 3 of the 4 properties being industrial, or the industrial ones transacted. So that's the first thing. Second thing is we transacted a 2.7 hectare land parcel at auction under auction conditions, which I think is unusual. And I think that shows the confidence renewing and sort of the scarcity of industrial land in the Newcastle area. Thirdly, it's that flight to quality. So both the L'Oreal asset and the Pabilla asset, very high quality industrial buildings, well built,
well located,
good tenant profiles, both relatively short WALEs.
Yep.
And again, that potential reversion opportunity in a few years.
Yep.
Absolutely. So, moving on to the commercial office sector, and we've been talking about this, since the PCA report came out at the start of the year. When you actually dive into some of the numbers that that report is producing, and just what we're seeing out there as well, look, the office market has taken a bit of a hit, last few years, and interest has been subdued, especially on the leasing side. We have noticed that there has been an increase in activity in the leasing side. I know, Matty, you're doing quite a bit in that space the first half of the year, but just to run through some of the numbers, look, the reason being is at the moment, there is an elevated vacancy level. we're sitting at about 16% vacancy, slightly up from last year, which was 17.9%. Total A-grade stock is about 146,000. We've got total vacancy, as I said, of about 23,500. Net absorption for the 12 months to January was 7,500. And, probably the big thing I think is that since, the last 5 years, we've had an increase in stock levels, total stock, A-grade stock that is, of, from 97,000 square metres up to, 146,000. So a significant increase and,
50% increase.
Nearly, 50% increase. 16% vacancy is elevated, and the market has had a backdrop of a tough period. But with a net absorption of 7,500, and looking at the supply coming in, like this year 3,100, next year's only 3,600, and pretty much under 2,000 for 27 and beyond. So naturally, as these there is that flight to quality. There is that return to the office mandate, which we're seeing play out in our market. Cafes are busier. Car parks are full. We're definitely seeing that. I saw in the, I think it was the AFR that said that in the March quarter, office towers have risen for the first time since 2022. So that sentiment's starting to come back. So I think if you look at our market, there's, yes, there's 23,000 of vacancy, but that's going to be absorbed over the next, 2 years. And then there's next to no supply coming in. So in the same conversation that we're having with industrial, with, limited supply has, created this rental reversion piece, I can see pressure on rents gaining and, the incentives really coming down as well. In the not too distant future, there's a bit of pain probably in the short term, but the existing stock and some of the transactions we saw last year, buying well below replacement value, I think there's a massive opportunity if you're brave enough to, take the punt now, get in and actually get ahead of it. So what do you reckon, mate?
I agree with everything you just said. They've transaction last year. The Corval guys bought. I think they've bought that. Were brave, and I think in the not too distant future it'll pay off for them. The CBD is constrained by the ability. Forget the supply and demand fundamentals. There's just not that many sites to be able to build a big office tower anymore. Or try and amalgamate a site further down towards Newcastle East to be able to build an office building. So, as you say, incentives have been higher. They've been sort of 30% or so. I know probably going back 10 years they were more like 10%. I'm not sure whether we'll get down to that low in terms of incentives because you've got higher face rents now than what you did historically. But I think you're right. There's some space to absorb, but it's not a huge amount. And as we're seeing, we go down and get a coffee in the morning in the cafes. There's more people around. And the leasing inquiry I've had since sort of taking on this role has been, a lot of it has been from tenants outside the CBD that want to be in the CBD. They understand that you don't have the generosity in parking allocation like you do in the suburbs, but they want to be. They understand there's public transport and there's infrastructure here to work with, and they want to be in town. So, I think generally speaking that all the signs are good, and I think we've in for some better times in the office market. Yeah,
and I think the landlords, and we touched on this, in the last year, landlords have reacted appropriately and started spec fitting out fit outs and making it more appealing, and having to sort of attract those tenants back to or attract those tenants to sort of make the move, which is, and they're being rewarded. We've done a couple of transactions. This first half of the year, over 1,000 square metres. For that, owners had to be convinced, and they were.
Yeah, that's right. There was one that was about 1,000 square metres that we've got a deal done on, and it had been vacant for quite some time. And spent a bit of money on it. Did some end of trip on the floor, and presented it a lot better to be more competitive in the market, and it's paid off. So. Those sort of things, landlords still have to do. If you're not doing that with your space, it is more challenging to try and lease it. But as the some of this space gets absorbed, I think you'll see, as I said, and as you said, the pressure on rents will be up,
Mm.
and the downward pressure will be on incentives.
Yeah, sure. Yeah, and look, we're not trying to sugarcoat it. It's definitely been a subdued market in office leasing, but I think within the short to medium term, that's going to turn around, and we're starting to see that sentiment change. So we'll keep an eye out for that. Just want to touch on the apartment market and also the development, sort of bleeding into sort of what we get into the development site space. Maddie, how are you sort of seeing, the supply and demand metrics, so the supply and demand sort of balance playing out? What's some of the activity going in our market in that space?
Oh, look, I think for if you're talking the residential apartment market in the CBD, it's the fundamentals are still strong there. The major developers that have been active in the last 10 years or through this cycle have been, the likes of GWH, Doma, Third Eye. They're all still very positive on the market. They've bought sites. GWH in particular. They've got their one project coming out of the ground. They've got their Era project over near the West Newcastle, and they're buying sites sort of down this bottom end of town as well for residential development. So. They see the market. They're the ones at the coalface selling the units off the plan themselves, and the same for the likes of Third Eye and Doma, and they're all seeing that there's genuine and strong sort of sale rates, and the square meter rates are sort of up around 14,000 a square meter now, and they're selling off the plan. So I think that's one thing. I think the other thing that's an interesting point to note is some of the private lenders, the larger non-bank lenders, are now in this market funding these projects. The banks have been a bit of a challenge for some developers to deal with, particularly around pre-sale coverage to get construction finance. Whereas you've got the likes of groups like Qualitas, MaxCap, those sort of very larger, sophisticated non-bank lenders are now in Newcastle, financing projects in Newcastle. So I think that's a positive sign for the market that larger sort of funders from outside of Sydney and outside of Newcastle in Sydney and Melbourne see the value in the Newcastle apartment market.
And look, and even with these rate cuts and possibly further cuts towards the end of the year, I think that's that could also spur the land and home sales as well. And I think it's just going to make these some of these apartments in reach of some of these buyers that may not have been there 12 months ago as well. So I think that will all start to play out. And really, the supply of new apartments coming into the market doesn't seem to be over-exaggerated either. I think there's definitely the developer constraints or construction constraints have limited the market as much as the cost, the pre-sale rates, but there's not a huge amount coming into the market in the next sort of 3 to 5 years. There's definitely some intent from developers, but they've actually got to get out the ground, which is a tricky.
They've got to get it out of the ground, and other markets like capital city markets have seen their apartment markets with a huge amount of oversupply, which had its implications for those markets. But we haven't had that.
We don't have
when I was in the Val role, I was dealing with a lot of sort of risk managers at the banks, and their whole view is when we'd sit down and sort of give them an update on the market and tell them how much stocks in the pipeline, they'd be like, "That's nothing. That's you guys have got no risk of oversupply." Even though Newcastle's a smaller market compared to Sydney and Melbourne, so I don't think we've got any issues in that respect.
Well, remember that property council lunch we went to mid last year? There was some astronomical increase in population coming to the immediate CBD, and I think they said there's 1.5 people on average that live in an apartment. So I think I did the maths at the time. Like there was thousands and thousands of apartments needed.
More. Yep.
So yeah, I think look, with the latest rate cut and that rate cut cycle coming in, I think hopefully it'll make these projects a little bit more feasible, get them out the ground. And but at this stage, I really don't think there's going to be a dramatic oversupply of new housing or new apartments in the CBD. So forecast time. So we're through the pretty well through the financial year. What is and we've touched on everything that's occurred in the last 12 months, especially in the last couple of weeks. It's lived a life. But what's your forecast for the rest of the calendar year. You first, Dan. What do you reckon, mate?
Yeah, so I think that rate cut we had just then was a big win.
Yeah.
So that was a big one. I was probably expecting 50 basis points, to be honest with you.
Yeah.
But I see the opportunity with the 0.25 for maybe to get another one sooner. And I think that will just keep building momentum in the market. I think on the back of that, we're going to see, again, this maintaining flight to quality. And then with registration of Black Hill recently and also the land in Heatherbrae, I think we're going to see some of these products getting out of the ground with developments and new tenants and occupiers coming in.
Yep. What about you, Matty?
When it comes to like real estate generally, whether it's office, industrial, residential development, for the most part, the how it moves is all dictated by fundamentals around supply and demand. You know, the cost of borrowing has an impact. And it has had an impact. We can see that. But, you know, as I said earlier, like through 2024, there was talk of rate cuts, and it didn't happen. And it didn't really, I guess, boost confidence too much because it was difficult to do transactions last year. But I think now that it's actually happened, I think that's going to just add a level of confidence to the market. And, you know, moving forward with more rate cuts, going to add more confidence. We've got a strong underlying economy here, and most of the sectors that we deal in have all got, you know, relatively speaking, strong fundamentals underneath them. So I think with that confidence, it's going to just be, you know, improve the market, see values increase, make deals easier to do. I think it's, generally speaking, just positive across most of the sectors we're dealing in.
Yep. No, I agree. I think that the rate cut's definitely going to stimulate activity. But elevated construction costs are still waning on the market for new projects. We are still seeing projects getting out of the ground, but it's definitely restricting that new supply. So I do still think that we're in a refurbishment cycle as well. I think that there's repositioning existing assets, buying assets well below replacement cost is still going to trend for the next 12 months at least. And I think just getting creative, or we're going to see a lot of value-add investors getting creative on how they can reposition assets that are, have got good fundamentals in the right area, good parking, talking commercial space, of course. But I still think in that refurbishment cycle, you're going to see a lot of adaptive reuse. If we get some improvement with some of the vacancy for commercial office space, we're going to see a little bit more activity coming into there as well. So, that trend, if we get a 50 basis points or 100 basis points further down, on the interest rates, it'll be great to see how that actually plays out in the market. But I think that refurbishment cycle is still here to stay for the next 12 months at least. Well, look, I think we'll leave it there, guys. I think we've covered off on sort of the hot button topics for the moment. So I appreciate you coming on. And look, thanks to our listeners. We'll wrap it up there, but we'll be sure to keep you updated throughout the year.